The Federal Reserve could make an announcement tomorrow that will cause stock and crypto markets to surge. I'm not talking about cutting interest rates. This decision would represent a complete shift in policy, but they have no choice but to make it. They will call it operational reserve management, but here's what it really means. They're about to turn the money printers back on and send this bull market into overdrive. Look, if you think the economy is what moves the stock market, you couldn't be more wrong. It's not Jerome Powell setting interest rates either. The market doesn't run on policy. It runs on plumbing. I'm not talking about copper pipes. I'm talking about the invisible machinery that moves trillions of dollars between banks overnight. It is the boring, acronym-filled layer of finance that 99% of us ignore because, well, it's boring. But I'll tell you a secret. The plumbing is the only thing that actually matters. Now, what you're looking at here is the S&P 500 index on top in blue and the U.S. money supply below in green. Now, they're pretty similar charts, right? Here, let me smooth out the S&P. I'll make that a 10-period moving average. Do you see it now? When the money supply expands, stocks rise. When it shrinks, they fall. In extreme periods like 2020, when the Fed printed trillions to cover federal stimulus packages, the stock market took off like a banshee. When inflation got out of hand a couple years later, the Fed then cut rates, took action to shrink the money supply. This caused the 2022 bear market. Now, most of the time, the pipes come along silently, but every few years, this plumbing gets clogged. And in the global financial system, a clog doesn't mean a toilet overflowed. It means the credit markets freeze, the stock market crashes, and the Federal Reserve has to panic. And right now, if you listen closely, you can almost hear those pipes rattling. The warning lights are red. The smart money in the bond market, the institutional giants who move markets while the rest of us argue over meme stocks, are positioning for a massive shift. They believe the Federal Reserve is about to pivot. And no, I don't mean cutting interest rates by 0.25%. We're talking about turning the printing press back on. We're talking about a program that will pump anywhere from $20 to $60 billion of fresh cash into the system every single month. But here's the catch. They're going to look you dead in the eye and tell you this is not quantitative easing. It is, but they're not going to say it. They're going to use fancy jargon like reserve management and discount window. But here's what it means. They're about to start pumping money into the markets again. They are turning the faucet back on. So I invite you to ignore the headlines and let me walk you through what really moves markets and what I believe is coming in 2026. Now, to understand why the system is fragile, you have to understand something called the repo market. Now, repo, which stands for repurchase agreement, that market is essentially a massive overnight pawn shop for banks and hedge funds. So it works like this. Let's say a bank has a treasury bond, a safe asset, but they need cash. They got to pay bills, settle trades, write a big mortgage, whatever it is. So they go to the repo market, say, hey, hold my treasury bond overnight and lend me the cash. I will buy the bond back from you tomorrow for a slightly higher price. Still make a little bit of interest on it. And this transaction happens trillions of times a day. It is the grease that keeps the gears turning. Without the repo market, money stops moving. And if money stops moving, so does the economy. Now, normally, again, this market is super boring. Banks charge each other tiny amounts of interest, something known as the repo rate, to swap cash for bonds overnight. But what happens if everyone owns bonds and nobody's got cash? Well, it's happened before. A few years ago, September of 2019, and back then, the Fed was doing exactly what they're doing now, something known as quantitative tightening. Basically, the Fed was trying to slim down. Okay, they're letting their bonds expire off their balance sheet to suck cash out of the system. So the Fed, think about it, they're either putting money in the system or taking it out. Okay, so when you have quantitative easing, that means they're printing money, they're using it to buy bonds, and don't worry about what they're buying. The fact is they're pumping hundreds of billions into the market. All that money is going to cause price to go up, right? When they're tightening, some of quantitative tightening, which they've actually been doing for the last 2 years, they're trying to shrink that balance sheet. All that crap they bought for the last few years to pump money in the market, they either let the bonds expire and don't buy anything else, or they sell them, so they're taking money out of the market. That's what they were doing in 2018 and 2019 because they thought the banking system had plenty of cash left. They thought the plumbing was fine, and they were wrong. Because on September 17, 2019, two seemingly routine events collided. One was corporate tax day. So companies withdrew all this cash from banks to pay Uncle Sam. And second was a big treasury auction. The government sold off new debt, issued more bonds. People bought them, sucking more cash out of the system. So suddenly, overnight, the banking system ran out of grease. Banks, of course, rushed to the repo market to borrow cash that they always have, but there wasn't any. And the repo rate, the cost to borrow money overnight, exploded. It went from a boring 2% to a panic-inducing 7% in just a couple of hours. It was cardiac arrest for the financial system. Trading desks froze. The Fed lost control of the price of money. And so to fix it, they essentially rushed in with emergency hoses. They printed billions of dollars overnight to flood the market with liquidity. It was really embarrassing for them, to be honest, but it proved that all these smart guys at the Fed didn't actually know how much cash the system needed to survive. Now, why does this matter today? It's not just story time. Well, because the Fed is terrified it's going to happen again. They see the same signals flashing now they saw back in 2019, and they know that they keep draining cash, they're going to hit the wall again. Now, the Fed operates on a framework called ample reserves, all right? And think of the banking system like a giant bathtub, all right? The water in there, that's the bank reserve. That's cash held at the Fed. And the drain kind of symbolizes quantitative tightening. They're sucking water or money out, whereas the faucet would be quantitative easing, all right? Now, for the last 2 years, the Fed has been pulling the plug on the drain to fight inflation. They are shrinking the money supply, intentionally lowering the water level. And the Fed's goal is to keep that water level at ample. Low enough so there's not an excessive splashing around, a big inflation, but high enough that they're not crashing the system. But here's the problem. The Fed is driving blind. They don't actually know where the bottom of the tub is. Now, look at this. This is a chart of the Federal Reserve's balance sheet, and here it is in 2019 when they hit the bottom. Notice again, they were doing exactly what they're doing today. They were shrinking the balance sheet, quantitative tightening, and they just got too tight. They had to pump a bunch of money into the market. Then, of course, we got 2020 with COVID. They printed like crazy to save the economy, to pay for stimulus. That eventually stalled. They kept printing more. And then here in 2022, they began to tighten, to shrink the balance sheet. That, of course, coincides with the bear market. And they've continued to tighten, shrink the balance sheet for the last 3 years, down from an eye-watering $9 trillion to about $6.5 trillion. Now today, estimates suggest that the danger zone is somewhere around here, about $6.5 trillion. And the repo boys on Wall Street are screaming, the water's too shallow. There's not enough liquidity. You need to pump money back in. Now you might be asking a logical question, which is, look, U.S. government's issuing trillions of debt. Banks are profitable. Why don't the banks just buy the debt and lend the cash? Why does the Fed have to get involved? And this is the most critical part of the story because the banks are essentially handcuffed right now. The government broke their legs with regulations. There's a rule called the supplementary leverage ratio, the SLR. So this all came after the 2008 financial crisis, obviously with well intentions. So the regulators kind of told the banks, look, to make sure you don't go bust again, that you cowboys don't do this, you have to limit how much stuff you own relative to your capital, your assets versus your reserves. So one way to think of it is like every bank has to wear a backpack, all right? And the regulators came in and said, that backpack can only weigh 50 pounds. But here's the insanity of this rule. Everything counts as weight. A risky loan to a bankrupt startup goes in the backpack, but it takes the same weight as a super safe, risk-free treasury bond. Even cash goes in the backpack. And so right now, the big banks, your JPMs, your Citi, your B of A, they have full backpacks. Their balance sheets are saturated. They literally cannot buy more treasury bonds or hold more cash without raising expensive capital or firing clients. So we have this standoff. The Treasury says we need trillions in debt to fund the deficit. Our boys in Washington won't quit spending. We're only taking in so much. We need another $2 trillion this year. The banks are over here going, sorry guys, backpack's full. Regulators constrained us. We're not allowed to buy any. And then the free market is going, all right, well, if nobody buys this debt, rates are going to spike. They're going to break things because that's how it works with bonds. The price of a bond and interest rates move inversely. If everybody wants bonds, they're all buying, they'll pay more and more for them. So the yield shrinks. The interest rates go down. If nobody wants your debt, if no one can buy it, they won't pay $1,000 for it. You get a discount to $950 or $900 or $800. And as you do that, the effective yield of that bond, how much you get in interest payments versus what you paid, rises. That's what causes interest rates to go up, which obviously they don't want. So this leaves only one buyer left in the room, the Federal Reserve. Now, the consensus among the plumbing experts, we'll call them, is that the Fed is about to announce a new program to keep the water level in the tub steady. They need to stop shrinking and start buying. They need to inject roughly $20 to $60 billion of cash every month. But, and this is the funny part, they're likely going to buy Treasury bills, not Treasury bonds. And the reason is so stupid. The Fed, it's an ego play. They are terrified of looking like they gave up on the inflation fight, which of course they caused. So if they announce QE, the stock market parties, crypto moons, and inflation expectations rise. So they're not going to call it that. They're going to call this operational reserve management. They'll claim it's totally different from QE. Quantitative easing, stimulus, they buy long-term bonds, 10-year, 20 years. That lowers long-term rates. But reserve management, that's just buying short-term bills, 3 months, 6 months. Look, tomato, okay? If they're printing money to buy assets, liquidity is increasing. And when liquidity increases, asset prices go up. The market does not care about the duration of the bond. They care about the direction of the money printer. And if the Fed is buying $50 billion this stuff a month, that is $50 billion in liquidity that private investors don't have to soak up. So that money goes elsewhere, usually into stocks and other risk assets. Now, to really understand the squeeze, we need to look at two specific accounts that are sucking the life out of this market. First is the Treasury General Account, the TGA. So this is basically the U.S. government's checking account. When you pay your taxes, that money goes out of your bank into the TGA account. And money in your bank is liquidity for the system. It can be lent to fuel the economy. Money in the TGA, money with the government, on the other hand, is locked away in the government's vault. And right now, the government is trying to keep a massive cash buffer in the TGA. And the recent shutdown only made this worse. They're trying to hold $700 to $800 billion at all times, nearly $1 trillion. That used to be in the banking system that is now locked away. That drains the tub. And second is that reverse repo facility. This is kind of like an overflow parking lot. So money market funds, right, the ones who manage your savings account, the little local bank, they're parking hundreds of billions of dollars at the Fed overnight to earn a little bit of interest, maybe make 2 or 3% a year. And when money's in RRP, it's not lending to banks. It's not buying stocks. It's just sitting there. Now, the Fed had hoped that this money would flow back into the system to buy these treasury bills, but it hasn't. So between the TGA hoarding cash, the reverse repo facility trapping cash, the actual banks are running low. This is why the Fed has to step in with a water hose. So big picture, why is this all happening? Well, it is happening because the United States government continues to run massive and growing deficits. We are issuing trillions of dollars in debt to fill the gaps between spending and income, and that's during peacetime. That's with a strong economy. And someone has to buy that debt. Foreigners, China, Japan, they're not buying as much as they used to. They hate the dollar. They want off of it. They've just scaled back their demand big ways. Banks can't buy it because their backpacks are full. In hedge funds, they're only going to buy it if the price is cheap. If those bonds come down enough, deliver them a nice, fat, higher yield. So what we are entering is a new financial landscape, one in which the government's debt is so large that the central bank has no choice but to monetize it to keep the system from collapsing. Buying treasury bills is the first step. It is the admission that the private sector cannot absorb all this government debt alone. They're issuing so many bonds, we don't want them. So what does this mean for your portfolio? Well, if this announcement happens, and the rumors are getting louder that it is, it represents a regime change. For the last 2 years, the narrative has been the Fed is tightening, cash is leaving the system, don't fight us. If they start buying bills, that narrative flips. The Fed is supplying liquidity. The floor is in, the plumbing's secured. So here's what we're likely to see. By the Fed stepping in to buy bills, they're putting a safety net under the banking system. They're going, all right, we won't let the plumbing break. And when you remove the risk of a systemic crash, investors get a lot more aggressive. They feel safer taking risks. They're buying crypto and growth stocks, etc. In addition, when a whale like the Fed starts buying up tens of billions of dollars of these T-bills every month, rates on those bills will fall. They don't care what the price is. They say we're going to buy 30 billion of them. They just buy them market price. That drives the price up, which pushes short-term rates down. And what that's going to do is steepen what's known as the yield curve. So short-term rates are going to go down, but long-term rates are going to stay up. So this does not look like this action, at least, is going to drive mortgage rates lower anytime soon. And what is likely to outperform are the assets that love liquidity. Tech stocks being one. Big, high-growth stocks, your Palantirs, your NVIDIAs, your all the AI-related stuff. Those feed on liquidity. Crypto. I'm not a big Bitcoin guy, but it is arguably the purest liquidity barometer in the world. It hates quantitative tightening. It loves balance sheet expansion. It loves money going into the system. And regardless of how the Fed tries to downplay it, crypto markets treat any balance sheet growth as a buy signal. And finally, one of my favorites, of course, gold. If the Fed takes this action, it will be seen as the first step toward admitting we have to monetize the debt. That means inflation, and gold is the ultimate inflation hedge. The fact is this: the global financial system is built on debt, leverage, and the assumption that there will always be cash available to settle trades overnight. The Fed tried to take the punch bowl away. They tried to drain the bathtub, but they are realizing the tub is leakier than they thought, and the bottom is much higher than they expected. They're trapped. The government is simply issuing too much debt. The banks are regulated too strictly to buy it, and the economy is too fragile to handle a liquidity crunch. So the dealer of last resort is returning to the table. They won't call it QE. They won't call it stimulus. They will call it operational reserve management. They'll try to make it sound so boring you stop paying attention. But don't stop paying attention. This is the signal. This is the signal that the draining is over, that the refilling is about to begin. And in that scenario, bonds go down while stocks, crypto, and gold go up. Like this video? Cool. Subscribe. I'll make more of them.